Hello friends, I am Swati Kulkarni, the fund manager with UTI Mutual Fund, and I am here with an update on UTI's large cap equity fund, UTI Mastershare Unit Scheme. The fund invests in companies with sustainable advantages over competition and follows principles of growth at reasonable price while selecting stocks. We typically look for advantages which could result into pricing power or low cost of operation for the companies. Our endeavor is to build portfolio with companies which have strong fundamentals like strong balance sheet with low debt, sustainable cash flow generation, profitability focus, and higher or improving return on capital employed. Businesses often go through cycles like ups and downs. Some businesses are more cyclical. For example, the cyclical businesses, the companies in such businesses which have strong competitive franchise often are available at attractive valuation because the market underestimates their ability to bounce back when the cycle turns up. Examples can be found in sectors like the metals or automobile or financial services. Whereas the non-cyclical businesses, what we look for is the strong return ratios and long growth runways. Such examples could be found in sectors like the consumer or retail, for example. So typically, by following the growth at reasonable price approach as well as competitive franchise, our endeavor is to spot such opportunities both in cyclical as well as stable businesses. Now, let's look at our thoughts on the portfolio sector allocation. The fund is overweight at this point of time in sectors like automobile, consumer services, industrial manufacturing, healthcare, telecom, and IT sector. In last 6 months, we have seen that commodity-based sectors like oil and gas, metals, as well as the power sector, we have seen these sectors doing well, outperforming the market based on the strong rally in the commodity prices. We have been underweight on sectors like power and oil and gas, and we have underweight position on metals as well. But we are not going to change the stance because we believe that the rally is led mainly due to supply disruption, and with central banks across the globe taking actions in terms of the monetary policy to tame inflation as well as the somber demand given the slowing global growth scenario, we think that the prices could be softening as we move ahead. More so if the supply disruption that we have seen becomes or starts to ease with the geopolitical tension easing off. So we are not changing our stance at this point of time. Now let's look at what changes we have done to the portfolio. We have increased our allocation to the sectors like financials, where we have preferred private sector banks with large proportion of current and savings accounts because that is a source of low cost of funds. And we believe that in a rising interest scenario, such banks would be able to show increasing spreads. In terms of other addition is also in automobile sector, where our thought process is that with supply side start to ease up, the raw material availability as well as prices could soften and there could be a case of earnings growth revival in this sector. Now, how are we guarding our portfolio in terms of the rising interest cost? Well, 90% of the portfolio today is into companies that have generated operating cash flow positively last 5 years consistently, as well as we have preference for low debt for the companies that we invest in. We believe that this will help us the portfolio to guard versus the rising interest cost. Thanks for connecting today with us and have a great time ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.